Okay. So, like I indicated, that was awesome. Um, I'm highly impressed, and I love the way you collaborated and shared rules for each group member to participate. That is great. So let's look at, I call it questions and discussion time. The first thing I would want to bring on board for us is, at a point you were using the word assurance. Okay. So I want us to juxtapose that with the word insurance and see the differences between the two. So why assurance and why insurance, my dear professors? I'm waiting to hear from you.
Please, your line is breaking.
Oh, okay, sorry. Can you hear me now?
Yes, please.
Okay, so I was asking that we differentiate between the term assurance and insurance. Because at a point I heard you using the word assurance. So I want us to see the difference between assurance and insurance. So if you can do that for me.
Okay. So assurance is similar to insurance, but like assurance typically refers to like a guarantee of a certain outcome or provision of a benefit, usually related to life or health. You see. Or like insurance is focused on the protection against the loss and the damage. Please, have you seen the difference?
Okay.
Like assurance, like it implies a promise of payout or benefit at a future date, whilst insurance is like protecting yourself against a loss or a damage.
Okay. Okay. So I think that for us to be very much appreciative of the use of these two words. So if you do a comparison, you would see that there are certain risks, though uncertain, but to some degree they are certain. That is to say that it is definitely going to happen, just that you don't know the timing. So when you pick death, for example, it is going to happen. It is certain that it will happen. You will die, right? In terms of age, it is certain that you reach 60 years, you reach 30 years. Okay. But for insurance, okay, that level of certainty of it occurrence is not there. Even though there is that probability that is going to occur, the the certainty of such probability is immeasurable. Okay. So for example, if you compare death to an accident, both are bound to occur, but you would say that death is inevitable, right? Comparable to accident. As in, it is certain that you will die, but it cannot be too certain that you'll be involved in an accident. Okay. So though the two words are similar and connote the same meaning at certain or in certain contexts, there's a little difference between the two. And I wanted to bring my professor's attention to that. Okay. Uh-huh. So in the event of insurance, you see, it is covering risks that may or may not occur. But for assurance, it is covering a risk that will occur. I don't know if that makes sense. Because death will definitely occur. But a fire may or may not occur. Right? Okay. So that is the reason why all the policies surrounding the life of a person, be it death or age, has to do with the term assurance. Assurance. Okay, so thank you very much for that brief clarifications. If there are more questions on that, I think we can judge on. Another thing I wanted to bring on board, I think you spoke about the types of life assurances. And that was awesome. Let me see if I can go back to that slide. The various types of life assurances. So you spoke of the whole life assurance, the term. Is it life term or term life? I want to get that point clear. Can my professors hear me? Is it term life or life term insurance? Or lifetime assurance, I should say.
Now, according to AI, it says lifetime.
Okay. Well, so lifetime as in the lifetime of the person, right?
Hey, wait. Sorry. Term life assurance.
Okay, term life assurance. Okay. So I wanted you to throw more light on that because I was getting some. So if you can restate that part, I think Ella, you did that part, right? So if you can reiterate some of the points you make there.
Okay. So this policy provides coverage for a specific period, like 10, 20, or 30 years. If you pass away during this term, sorry, your beneficiaries will receive a payout. If you outlive the term, there is no payout.
Okay. So what is the difference between the whole life and the term life?
Okay, so the whole life it provides a coverage for the entire lifetime of the insured, sorry. As long as premiums are paid, it includes like so whole life is like your whole life. This in whole life you don't outlive them, but term life, sorry, it gives you a specific period.
Okay.
You are
Professor.
given a specific period, but whole
Okay.
life.
Okay. I think Prof. Ikea wanted to add something, or Prof. Senam.
I'm okay with what she said.
Okay. So the clear distinction between the two is that for the whole life assurance, you see, the beneficiary is only compensated or receives um the sum assured only when the insured or the person is dead, right? So until the person is dead, the insurance company is not going to, as it were, compensate the beneficiary. While for the term life, right, like you stated, is for a specific term or duration. So if it is 5 years and the person is not dead, the 5 years has expired, the beneficiary will receive such amount of money. If the person should die before that maturity, the beneficiary again would get the benefit. So the clear distinction between the two is that for the whole life until the person is dead, nothing is paid. But for the term life, if the person is not dead but the agreed period of time or the term expires, then the beneficiary can claim the benefits in there. So that's the clear distinction between the two. Okay. Yes, Prof. Senam.
And she said, please, I'm a bit confused with the term life because so if the term comes to an end, they can claim the money that has been paid, the premium.
Come again, take the question again.
Yeah, please, I'm asking that if the term that they give, maybe they ensure that maybe between the 10 years, if he dies, they'll give the person. So what if he doesn't die? Do they still give them the money or they extend this? I don't know.
Yes, so you see, the term in there means that when we say a term, it means a specific period, right? Starting from an agreed time to another agreed time. So if that term expires, like for 10 years, if that 10 years is matured or is due, then the beneficiary can claim, even though the person might not be dead, right? But for the whole life, it is only payable when the person is dead, right? So you see, I can enter into a whole life
Yes.
assurance policy, and my premium payment could be one that maybe is for a specific agreed period of time, right? However, until I die, the beneficiaries are not going to receive anything. So it's contingent on my death, right? But for the term life, even if I'm still alive, but the agreed term, be it 10 years, 5 years, has expired, the beneficiaries could claim the benefits therein. Is that okay?
Oh, yes, please. But so what's like situations would cause someone to go in for the term life assurance?
Okay, so people want to go in for the term
Like,
life. Yes, come again.
yeah, so I was saying that, is it like though as a business, like contract or something?
Are you asking, is it like a contract?
Yeah, like why would someone like place like sort of a bet on their death that if they die within this time, then someone take money for it or something?
Yes, so it's like, okay, so let's assume that I'm 35 years now, right? And then I enter into a term life assurance that, oh, in the next 50 years, the probability of me dying is very high, because that will mean I'm maturing into my 80s, right? So I go into this specific time period that I'm 35 now. So how many years from now? That's like 50 years from now, right? I want to make regular monthly payment as premium, so that when I die, okay, my beneficiaries, solely my dependents, will get some kind of financial cushion. Now, if it so happens that at age 85, I'm still alive, I'm not dead, the issue is in the insurance contract. The specific duration for which I agreed to pay the premium has expired, so my beneficiaries can claim the benefits. Okay.
Yes, please.
But for the whole life,
So
I would
it
have to
like
die.
you just take it.
For the whole life, I would have to die before they
Okay,
can claim. So that's the difference between the two.
thank you.
Yeah. But within that 50 years, if let's say I die in my 60s, equally my beneficiaries can what claim under the term life insurance. Okay. Uh-huh. Any other questions or maybe confusions that we may want to look at? Yes. Nanecha, please go ahead.
Please, can you explain the universal life assurance?
Okay, so I think our professors, Professor Chan wants you to throw more light on the universal life assurance, unless you would want me to do it on your behalf. then I'll do. But
Yes, please. I want you to.
okay, so you see, for the universal, okay, it is I think most of our insurance companies really put in that to, as it were, encourage people to buy this kind of life assurance policies with them, because most of the times people are not interested because they feel like, I always have to die for people to enjoy. So this universal life assurance, okay, is a type of a permanent life insurance, okay, but it combines death benefits with some savings accumulation or a form of investment. What do you call it? Investment component added to the death bit. Okay, so it's not like it is focused on the insured dying, but then a specific savings or investment package is added to that kind of what do you call it? Insurance policy. Okay, it's a bit complex and difficult to understand, but it's a way of getting people to do life assurances with insurance companies. Okay, so let me see if I can cite a scenario that will make you understand better. Okay, so I think SNET. How many of you know SNET, right? The Social Security. So you see, what do they do? They are taking your money, but they are investing it so that in the event of your retirement, when you are nearing your death, okay, they sustain you financially by paying you some monthly bills, right? So it's not solely because solely on the fact that they are taking your money when you die, they pay you some benefit, your beneficiaries some benefits, right? But they provide that savings and investment option for you. So mutual funds, I don't know if you have heard of mutual funds. So in a way, they take your premium and kind of invest and save it in funds that can generate more value for you. I don't know if it makes sense with what I'm saying.
If your line is breaking.
Ouch. Okay, is it okay now?
Yes, please.
Okay. So I'm saying that what makes the universal life assurance unique is the savings or investment bit embedded in that type of insurance. Okay. So there is a savings and investment component. So I gave you a typical example like SNET, and this for teaching. If you have heard of Ghana National Association of Teachers, they run this mutual funds where members contribute until their retirement. Okay, and when you are going on retirement, because they have invested your monies into some form of ventures, they pay you some value. Even though sometimes it happens that the value might be lesser because of certain prevailing market and economic conditions. Okay. So, Professor Chan, the uniqueness of the universal life assurance is the savings or investment bit embedded in that type of policy.
Okay, thank you.
Okay. Now, interestingly, within your lifetime of a universal life assurance, you can even go for. I think you've heard of this cash. They call it for partial withdrawal. Yeah, partial withdrawals. You can go for some of your money at a certain point. Okay. Okay. So I think we are good here. So we can continue. But I wanted to hear about endowment life policy. Endowment life policy. Did you ever come across that? Can we look at that? Endowment
Yeah,
life.
yeah, yeah, yes.
Okay.
Yes.
So what is that?
This type pays out a lump sum either upon the death of the insured within a specified period or at the end of that period if the insured is still alive. It is often used as a savings plan for specific goals like funding education or retirement.
Oh, okay. Okay. Great. So let's move on. Let's move on. Any more questions from Professor Chan or even the group smart ladies? Yes, I think I want you to throw more light on the consequential loss. Consequential loss. And if you can cite examples or scenarios to make the picture clearer, I'll be very glad.
So please, I was going to ask you to explain it to me a bit more.
Okay, so consequence, the consequence of an action. Prof. Ella, Prof. Ekuya, or maybe Prof. Chan, you may want to tell us something here. Consequential loss. What does that mean? Oh, just express your opinion, right? Okay, so if I want to make a point about that, okay, Professor Ekuya.
I think it's like the risk is not on what was damaged, but then what resulted from what was damaged. Like maybe if the fire caused damage to the property,
Okay.
that's not what you are insuring against. You are insuring against the fact that because of the loss of property, you lost sales or rents. You lost your
Okay.
ability to rent out also. Yes.
Okay.
That's how I
Okay.
understand it.
Okay. Okay. Okay, so that is true. Consequential loss is an indirect damage or loss suffered as a result of the occurrence of an event, right? So, like you stated, I own a barbering shop, and then fire destroys the shop. Okay, the consequential loss would be that had it not been for the shop being burnt, I would have been making sales from barbering people's hair, right? So that sales I'm losing because the fire has destroyed the shop becomes a consequential loss. If I have a car and I'm supposed to go to Accra, however, because of an accident, I cannot go to that Accra, okay? Then the consequential loss will be how much I'm losing for not being able to go to Accra with the car. If I have to spend money to replace certain parts because fire has destroyed the car, then that will also be a consequential loss. So they are the indirect losses that arise out of the occurrence of an event or an incident. Okay. Okay, great. I think we can move on. Any further questions or contributions? Okay, then I wanted us to clear or speak more about the motor insurance, the types of motor insurance specifically, where you talk about the third party and the comprehensive. So who is going to do that for us? The motor vehicle accident. insurance. Yes. Prophet, I'm sure you have heard this one. Comprehensive and third party.
Yes, please.
Okay, so can you expand on that for us? Maybe you can set examples to explain, or Profela, you want to assist us? Okay, so when you talk about the third party and comprehensive, I think the name comprehensive suggests to us that comprehensive means it's covering everything, right? So under the comprehensive, what happens is that the owner of that vehicle, right, insures against losses to him or her personally and to other third parties. So it covers everything. So for example, if I'm driving my car and I hit somebody, right, not deliberately, then the comprehensive is going to first look at the person who I knocked down, and also look at me if I've suffered any losses, right? But the third party only focuses on the person I knocked down. If I the owner, sustained any injury, I will not be catered for. So that's the difference between the two. Okay. I think we'll look at you've covered a lot of the things that I was going to speak about. So I'll speak of these important terms, and then we may call it a day for today's lesson, right? So let's look at some of the terms that we may have to consider under insurance. Okay. So the first one is reinsurance. Reinsurance. I don't know if you have heard of this before, reinsurance, or the name should suggest something to you, right? We can also talk about who an actuary is. Okay, these are persons who are engaged, an investigator, then also look at underwriters. Underwriters. Okay. So reinsurance, any idea as to who or what reinsurance is? Yes, my professors, Professor Kia, Professor Senan, Professor. Oh, you don't want to express your views on that? Yes, Professor Chan, go ahead.
Please, I actually searched about it.
Okay.
Okay, so it's a way for insurers to transfer some of their financial risk to another company called the reinsurer.
Okay. Okay. So that is true. Reinsurance means that one insurance company can also insure whatever risk the insured has contracted them to provide compensation against to another insurance company, right? So reinsurance, that's what it actually means. So for example, Glyco Insurance can insure some of the risk they are insuring for insured to maybe SIC or any other insurance company. Okay. Yes, Prof. Senna.
Sir, please. So, I I was reading on it, and then I saw, like, you were saying the person transfers it to another insurance company, but then I saw the insurance transfers it to another insurer. So I want to know if it's the same thing or it's different, or what I saw was wrong.
Okay, so the reinsurance here is in the purview of the insurer or the insurance company. Okay, the insurance, not the insured, but the insurance company. So, like I gave you the example, SIC Glyco, they can have that reinsurance engagement. Now, the essence is for them to share the risk, okay, because the principle of contribution even permits that where an insured, though not expected to do that, but if he insures the same risk with two different companies, in the event of a loss, they will come together and compensate him or her, right? But reinsurance bothers about an insurance company or an insurer, right, transferring either fully or partly some of the policy from their client. Okay.
Yes,
Okay.
please, I understand.
Great. Okay. Okay. Okay, now let's look at the next term, which is an actuary. Who is an actuary? And what does he do? Okay, so an actuary is an expert, right? A professional who uses statistical, methods to assess risk in financial insurance. Okay, what they do is they use data or they analyze data to calculate probabilities that the risk will occur. Okay, to help organizations make decisions about insuring what type of insurance they should even go in for. So they do more of risk assessment and they analyze data. Okay, that is what an actuary does. The investigator, of course, is somebody who is involved in finding out what really happened in the event that the risk insured has occurred. Okay. Then the underwriters. I think I'll allow you to express your view on this. Who is an underwriter? Yes, Prof. Senna.
So, please, I think it is, I don't know, but I think it's also like the actuary, like he or she evaluates the risk,
Okay.
but then you pay the person for a fee.
Okay. Yes, any other view? Yes, Ikea.
I think an underwriter is like a link between
Ikea, your mic is
I
muted.
think an underwriter is the link between the insurance company and the insurer. the one
Okay.
being insured. So yes, like Senam said, I think the underwriter also analyzes risk
Okay.
to
Okay.
determine whether it should be insured against or not.
Okay. Okay. So yes, both of them seek to do the same thing, just that you see the scope. The scope really determines whether one is an actuary or one is an underwriter. So the actuaries focus on more broader risk management, okay, and product development, while the underwriters are focused more on individual policy holders and specific risk. Okay. So it's the scope that really distinguishes between the two. As it were, the actuary is more of a macro level. Macro means a bigger, you know, it looks at the bigger impact that risk is going to have on the insured and maybe other third parties, right? But the underwriter focuses on a micro level, right? Looking more of the individual policyholders and the specific risk associated. Okay. So these are a few things I think I wanted to bring on board, but I must say I'm highly impressed with the quantum of work you did for this presentation, and I'm so grateful. So I want to thank all of you for making it a success. I guess if there are no more questions, we'll wrap up here and save ourselves with a third session. Probably I'll put some questions on the page for you as assignment. Thank you very much and have a nice day.